to spotlight some of the big tech news. Caleb Silver's with us, editor-in-chief at Investopedia. It's finally happened. It's been almost 2 years. Microsoft acquisition of Activision Blizzard. I saw Bobby Kotick speaking today. And, he never really even expected that that he would get a call from Satya Nadella and this would be happening. But all the parameters taken, and it actually went through as promised, right?
Yeah, this is the biggest deal in Microsoft's 48-year history. I had to look at that number twice. 48 years Microsoft's been around. A $69 billion deal finally getting approved by regulators here in the U.S. and in Europe. And Europe was a big sticking point for the regulation here. But this is a huge deal for Microsoft. They get access to this terrific library of Activision Blizzard games that are so popular around the world. We're talking about Call of Duty, Crash Bandicoot, never played it, Tony Hawk Skater, I do know that one, awesome game, and then Warcraft, plus the entire library and the collection that Microsoft can now put into the Xbox, into the Xbox One Pass subscription series. This is a big deal for Microsoft and a huge deal for Activision, which was not doing great a couple of years ago when this deal was first announced.
So at this point now, it's pretty amazing. You have to wonder why Microsoft wanted this so badly.
Well, think about what Satya Nadella has done since he took over the company in 2014. We're almost coming up on 10 years since he took it over, and he has diversified Microsoft's revenue base widely and its product offerings, gotten him into the cloud in a big way with Azure. It's gotten him into gaming, obviously, through Xbox, the console, plus the One Pass subscription service, plus all the other enterprise revenue that he's built around the ecosystem of Windows, and that's paid off in a big way. Now, Xbox and the gaming part of Microsoft is not the biggest part of its business, not even close, but it is growing, and it is one of the fastest growing, fastest margin parts of the business, because once you have the Xbox, once you have the cloud One Pass series, then you're able to generate revenue without spending a lot more money up front. So getting the library of content's big. And Microsoft, like Amazon, like Alphabet, like Apple, they're in the content game too, and gaming is one of the fastest growing industries. That's why they want to get into it. It's not necessarily the money that Activision has made. It's done pretty well, $2 billion, I believe, last year. It's about the future and what Microsoft's going to be able to offer as a content, services, and software platform.
Yeah, I'm looking forward to see what Bobby Kotick does next. He's a guy from Long Island. That being said, let's talk about what's going on in the tech world. I saw a stat earlier this week. It said 239,000 tech layoffs this year. I mean, I didn't source it or whatever, but it certainly jumped out at me. And you're talking about Qualcomm layoffs.
Yeah.
What's the effect there?
Qualcomm's announced some layoffs, and it's announced some layoffs in its engineering department. I believe it was like 1,258 job cuts coming out of its California offices. 750 of those, Nicole, are from the engineering department. What does that tell you? These are not call center jobs, right? These are not factory jobs. These are the people that actually make the chips. It's softness in demand, and Qualcomm's looking at a 19% decline in revenue this year because of the softness in chips. We went from this huge glut of chips, and we couldn't get enough over the last couple of years, to all of a sudden too many chips, not enough demand. That's hurt Qualcomm a lot. Think about its biggest customers too. Apple, about a third of the revenue there. They're seeing some softness, even though they have the new phones coming up. But Qualcomm is still the biggest provider of chips. But Qualcomm's a big provider of chips also to the automotive industry. And we know we couldn't get enough chips there. We were talking about this, I think, exactly a year ago. Now we're not getting enough car sales because of those high borrowing rates. Not a lot of demand right now for new cars. So that's why you're seeing the softness. And if Qualcomm's making cuts, one of the biggest chip makers on the planet, you got to wonder what's happening through the rest of the industry.
I mean, when you think about what people are looking up at this point, I had a great conversation a short time ago with Stephen Guilfoyle, who I'm sure you know or met on the floor here. He talked about moving high into cash. And I know on Investopedia, you have a lot of folks looking up things. You have the anxiety index. I'm curious to see what some of the things they're talking about, obviously the geopolitical concerns. But he said the interest rate yield curve is concerning. And that was one thing that was on his mind as well.
Yeah, we just wrapped up our bi-monthly survey of our newsletter readers, and they're as cautious, Nicole, as they've been all year. And cash seems pretty comfortable right now, especially when you're getting 5 to 6% at the bank. You're getting yields, high yields on bonds, but people are not that interested right now in government bonds. They're interested in protecting their cash, worried about another potential sell-off, another leg down. Even though this is the seasonally strongest time of the year, they're still pretty cautious right now. And because there are alternatives, and they're pretty good alternatives at the bank, why make the risk and delegate more cash to the stock market when there's so much uncertainty? Last weekend, obviously tragic on so many levels, but also adding that layer of uncertainty kryptonite for investors. Hang out in cash, see how the rest of the month plays out, see how things look through this earnings season, which is just kicking off right now. We'll hear from the big tech companies in the next couple of weeks. Then they'll make a decision whether or not they want to get back in. But right now, things seem a little scary. So there's no harm in making no decision about allocating new capital to the stock market, kicking back in cash right now, buying a CD, a money market fund, or a money market account, and waiting until see how things play out.
Yeah. What about earnings season? When you think about the anticipation of what we can see, your thoughts?
Yeah, this could be a catalyst, but I don't think it's going to be a major catalyst like we've hoped for in the past, just because of all the economic uncertainty. Obviously, you have the potential for another government shutdown. You have what's going on in the Middle East, Russia, Ukraine, obviously oil, so many factors right here that could present walls of worry and obstacles for a catalyst for the stock market. But as you know, it all depends on what happens with yields, government bond yields, and the dollar. If the dollar keeps falling, stocks are going to continue the rally they started a week ago. If the dollar strengthens because of this concern and yields keep popping, well, they're going to sit out and watch these alternatives continue to play out, keep putting money aside in cash, not invest it right now. The good news? There's $5.6 trillion in money market funds right now that's just waiting to be deployed into the stock market. The bad news, there is no obvious green light or catalyst for that money to rush back into equities at this time.
All right. Caleb Silver, great to see you, of Investopedia. Thank you for always making sense of things for us.